Hello, hi everyone. How are you all? Hope all are well, right? So welcome to AI Smart Education. Today we are going to discuss about NTA UGC NET Commerce Paper 2, and in this lecture we are going to discuss about income tax unit, which is really important for your upcoming exam. So in this lecture we are going to discuss most expected MCQ on income tax unit, that is unit number 10, and we are going to see each and every question with the complete explanation, and this video will be helpful not only to the UGC NET student but also to the Commerce SET student who are preparing for upcoming SET exam. Okay, so let's start with the lecture. Before that, if you have not subscribed my channel, please subscribe my channel so that you will receive my lecture on the everyday basis. Charter accountant is, whether it is a profession, whether it is a business or a occasion, that here they ask you. Okay, here the charter accountant, that is a CA, is an international accounting designation granted to the accounting professional in many countries around the world aside from the United States. In the United States, the equivalent to the CA designation is a certified public accountant, that is CPA. Okay, for this the first option is profession, second option is vocation, third option is business, and last option is none of the above. Charter accountant is a profession. So the answer for this question will be option number A. Set of laws under the same head of a income comes under the section. For this the options given are section 60, second option is section 70, third option is section 80, and last option is none of the above. So here the each option given is important because most of the time under the income tax unit you will receive the question on the section. So you have to understand each section properly. So what section 60 says? Section 60 and 61 contain the provision when the income from an asset is a transfer without transferring the asset, or transferring an asset but the transfer is a revocable. In both the situation, income from the asset is treated as a transferor. Second option is section 70. Section 70 of Income Tax Act 1961 to 2020 provide for the set of laws from one source against the income from the another source under the same head of the income. Then is section 80. Here the section 80C is one of the most popular and a favorite sections among the taxpayer, as it allows to reduce the taxable income by making a tax saving investment or incurring the eligible expenses. It allows the maximum deduction of rupees 1.5 lakh every year for the taxpayer total income. The benefit of this deduction can be availed by the individual and a HUF. If you know, or somebody from you, if you work under the CA or a tax consultant, that time you will get the idea that 80C section we are using for the tax saving. Okay. Set of laws under the same head of a income comes under section 70. That means the answer here will be option number B. Expenses allowed as a deduction under section which under the head profit and gain of a business and a profession. The profit and the gain of a business and a profession is given under section 28. Okay, please remember here this is given under section 28. But in this question they ask you about the expenses which are allowed as a deduction. Okay, so for this the option first is section 20 to 25, second one is section 15 to 27, third one is section 30 to 37, and last one is none of the above. From 30 to 37, there are so many things which are included for the deduction under the profit and gain of a business and a profession. Section 30, what section 30 says, then there will be a rent rates, taxes, repair and insurance for a building. Then section 31 is there, which says the repair and insurance of the machinery. Then is the depreciation under section 32. Then is investment allowance in the notified background area in the Andhra Pradesh, Bihar, Telangana or a West Bengal, that is under section 32 AD. So like this there are 37 different section which you have to read before going to the exam, because this section are very important from the exam point of view. The answer for this question will be option number C. The next question here is long-term capital gain can be carry forward. Here what is the meaning of long-term capital gain, that you have to understand first, because to answer any question you have to understand the question first. So here the long-term capital gain means the investment that provide the return in the period range from the 1 year to the 3 year. If a person hold an investment for the 3 year, the profit is capital gain on the long-term capital asset. The first option is 8 subsequent assessment year. Second one is indefinitely. Third option is 6 years. And last option is none of the above. In case where the entire long-term capital loss cannot be set up against the gain, it is a carry forward for the next year. The long-term capital loss can be carried forward for the 8 subsequent assessment years. That means the answer here for this question will be option number A. That is, long-term capital gain can be carried forward for the 8 subsequent assessment years. Speculative business are. Here they ask you about a speculative business. Now, before answering this question, you have to understand what is a speculative business. A transaction of a purchase or a sale of a commodity, including the stock and the shares, settled otherwise than the actual delivery or a transfer of a commodity to script the speculative transaction. The business which consists of a speculative transaction is called a speculative business. As per the section 43(5) of Income Tax Act 1961, the intraday trading shall be considered as a speculation business transaction, and the income therefore will be either the speculation gain or a speculation loss. The income from the speculation gain is a tax at a normal rate. For this, the options given are partly taxable. The allowance which are partially taxable from the tax has a certain limit are called a partially taxable allowance as per the section specified under the Income Tax Act 1961. Then is fully taxable. Here the what is meaning of fully taxable? Fully taxable means whatever amount, whatever cash you are receiving will be taxable under the Income Tax Act 1961. Then is exempted. Whatever amount you are receiving will be exempt. There will be a no tax under the Income Tax Act. This is the meaning of the exempted. For the agriculture income, there is the income whatever we receive from the agriculture is a fully exempted under the Income Tax Act. Here the example of the exempted tax. Okay, and the last option is none of the above. Speculative business are fully taxable. Okay, so answer is option number B. Indexation will be allowed in case of. Here they ask you about the indexation. Under indexation, you are allowed by a law to inflate the purchase price of your asset by the government notified inflation factor. This factor is called cost inflation index, for which the word indexation has been derived. Okay. The first option is LTGC. Now what is LTGC? That is long-term capital gain. Here the long-term capital gain under the Income Tax Act means the profit earned by the individual on the sale of his investment in the assets such as a stock, real estate, bond, commodities. Basically, it is a gain made on the capital investment. Second one is STCG. Here the short-term capital gain. Short-term capital gain is a tax levied on the profit generated from the sale on the asset which is held by the government defined the short period is called a short-term capital gain. Third option is both, that is long-term capital gain and short-term capital gain, and last one is none of this. The correct answer for this question will be option number A. Indexation will be allowed in case of long-term capital gain. How many types of capital gain are there? Here they ask you about the types of capital gain. So there are two types of a capital gain, that is short-term capital gain and a long-term capital gain. The long-term capital gain means the profit earned by the individual on the sale of the investment in the asset such as the real estate, bond, commodity. Basically it gain made on the capital investment for a long time. And second one is short-term capital gain. Short-term capital gain is a tax levied on the profit generated from the sale of the asset which is held for the government defined for the shorter period. That is a short-term capital gain. The options given are 3, 2, 4 and none of the above. The answer here for this question will be option number B, that is 2. Treatment of loss after the succession come under, and the options given are section 78 clause 2, second option is section 77 clause 2, third option is section 76 clause 2 and the last option is none of the above. Section 78 of Income Tax Act set off of loss in case of a exchange in the constitution of the firm or a succession amended or updated noted on the section 78 of the Income Tax Act 1961 as amended by the Finance Act 2020 and the Income Tax Rule 1962. That means the answer here for this question will be option number A, that is section 78 clause 2. Long-term capital gain is a tax. In this question they ask you how much percentage is allowed for a long-term capital gain. For this the options given are 30%, then is 25%, then is 20% and none of the above. Now at present you must know what is a long-term capital gain because I have explained you in my previous question, right? So here the tax on the long-term capital gain is usually calculated at the 20% plus the surcharge plus the cess as applicable. Okay. The answer here for this question will be option number C, that is 20%. The next question here is unobserved depreciation can be carried forward for a period of. Here the unobserved depreciation is that amount of unutilized depreciation which is a assessee will not able to claim as a expense due to the lack of sufficient profit in the profit and loss account. Such an unobserved depreciation can be set off against the any head of the income and remaining balance can be carried forward for any number of the period. For this the options given are 8 year, second option is 4 year, third option is indefinite and the last option is none of the above. The unobserved depreciation can be carried forward for a indefinitely period. The condition of a 4 year or a 8 year are not applicable in case of a unobserved depreciation. Depreciation shall be carried forward even if the business or a profession has been discontinued. Order of a setup for the purpose of ITR. The answer here for this question will be option number C, that is indefinite.